Good day, fellow investors. We recently analyzed Apple, and it is a very expensive stock. But there were many comments discussing how, if it is so expensive, why is Apple Warren Buffett's largest holding? And actually 52% of his stock market portfolio, which is 350 billion. And in this video I want to discuss portfolio construction over time, which is Buffett's mastery, owning a business that Buffett does, and we, I think, tend to overlook what it really means. And when it comes to building a portfolio, also replacing with better, can you do that or not? Therefore better to hold. So let's take a look at Apple, and we have a clear situation here. The stock is up 6 times since the 2010s, and you would think, okay, now it would be smart for Buffett to sell this. The P ratio is extremely high at 32, the market cap is 3 trillion, the dividend yield is very low at 0.5 percentage point. But let's take a look at Buffett's portfolio and see how Apple fits the complete Berkshire picture first. If we look at the asset side of the balance sheet, we see that 164 billion is Apple. 164 billion is just 16% of assets. So any fluctuations in Apple, even if it crashes 50%, that would only mean an 8% change in the total assets of Berkshire. So that is not meaningful for Warren Buffett. Further, if we look at his cost price, the average buy price for Warren Buffett was $39.63 when he was buying the company. Since then, we are at a 5x, so we are now at 197. So if we look at the balance sheet again, he paid 33 billion for the current 164 billion. So any fluctuations there would be even less important when it comes to how much he paid and what he does as an investor. Then we continue with Warren Buffett, and his strategy is always to find a great business, buy and hold forever. His preferred holding period is forever, and he's not going to sell a great business, no matter the stock price. A great example on that is Coca-Cola. So he bought here the late 1980s at around $2 per share, a little bit more. He made a lot of money, 20 times his money by 1999, and since then we can say it's just flat, just the dividend 37%. Of course, it would be much better that he sold here, got 6% on the money, and then bought Apple here. Now he would have had 5 times more. But that is not Warren Buffett. He's extremely happy with his 70% dividend on cost because he is about owning businesses. What does it mean to own businesses versus watching stock prices? It is in our nature, but we always watch stock prices. We want our stocks to go up, but Warren Buffett also knows that the market is a voting machine in the short term. And now it is clear that the market is voting Apple up. Everyone is excited about it. A lot of money goes into it. Apple's buybacks that we have discussed also push it higher and higher. But in the long term, the market is a weighing machine. So for us retail investors, the company fundamentals and the market value, the fundamentals are great, but the market value is pretty high to weigh the returns on our portfolio. But as an investor, what does Warren Buffett focus on? On the underlying business and on his dividends. And if you turn it around and look at his cost, he's getting a good dividend from Apple, the business is getting better and better, and that's it. He is forgetting about the stock market. He knows that in the short term it is a voting machine, but he is weighing the fundamentals of Apple that are undeniably great. And now the third point when it comes to why Buffett isn't selling is replacing with better. We can with our portfolios, but for Buffett it is not that easy. Further, if we look at Apple now, yes, it is expensive, the P ratio is very high, but the P ratio of 32, that's a 3% return that they are doing buybacks with. If over the very long term Apple keeps growing at 5% thanks to its ecosystem, thanks to the services and my new products, that's a return of 8% from a great business long term. That is good for Buffett. That's better than 5% you can get from treasuries or 4% long-term treasuries. Apple can increase prices in case of inflation, and therefore you have also an inflationary protection if that treasuries don't give you. Keep in mind, he has 173 billion in cash. He doesn't need another 164 billion that he would get from Apple. He knows he paid 33. He knows the fair value of Apple now is likely 100 billion, and he doesn't care about these 60 billion that can go up and down. Now the market is voting in favor of Apple. In case of disturbance in the Apple force, it could go lower, but he doesn't care. He bought it for other reasons, and that is how he structures his portfolio over the long term. This is the greatness of Warren Buffett, not doing too much, or as he says, investing is about mostly doing nothing, but don't tell it to your clients. I hope you enjoyed this video. It's a very interesting thinking method and it takes time to sink in, and it is very hard. It is easy to discuss, but very hard when it comes to this application. This is Warren Buffett's 20-year strategy, and we are not trained to think in decades. Thanks for watching. I'll see you in the next video.